The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen. Thank you for being with us today. Good morning to my friends in the northern parts of Queensland. Good afternoon to the rest of you. And shaken, not stirred. Can you hear me all right everywhere in the world, folks? Just type in the question box if the volume's okay, please. Yes, got it. Okay. Everything's good. Well, delightful to have so many of you with us today. Lovely to see lots of old friends and familiar faces. Alan, who talked me into coming to Telife, for which I'm very, very grateful. Cameron's a new trader down in Melbourne. Chase, who wants me to give up smoking, and I'm sure he's absolutely right about that. Let's see who else we've got here. Lots of people. Move this down a bit. Chris, he's doing a tutorial. Dean's done tutorials. All the tutorial guys are here. Chip Stevenson, lovely to have you with us, Chip. Been a long time. Harold, my friend, the gold bug from Redding, California. I was talking to someone about you yesterday, Harold. Jack's with us, and Janet, the beautiful Janet over there on the west coast of Canada. Hope your leg's all healed up, Janet. You haven't heard from you for a long time. Jeff, he's in the middle of doing a tutorial now. Jeremy, he's done a tutorial. He's a Pommy guy, lives in the south of England, very nice spot. Jerry Winter, our favourite broker, futures brokers with us. We're honoured to have you with us, Jerry. Great to have you here. John, Marco, I know Tom's here. Here's Mark. He's going to be one of our gun traders. About time you talk to me again. Michael Peel over there in God knows where. He's a bloke, you don't quite know where he is. Mike Murphy, tutorial guy. Same for the next Mike, Big O. Good to have you with us, mate. Oh, lots of people here and all the friends. Rose over in Montana. Rose, how's the trading? Good to have you with us here. Sue up in North Queensland. About time we had a talk again, Sue. She's a pretty good trader. And Sue Assini, yes, good to have you with us. Tom, he's the wealth fund manager down in Florida. Incidentally, your friend keeps bemoaning that the natural gas trading hasn't been any good. Have a look at the chart. Since February 15th this year, it's really just doing a consolidation. There's no volatility in there. One of the great tricks of trading is to find and trade markets with plenty of vertical volatility. You want to see markets going up and down, not in a narrow range going essentially sideways. Anyway, good to have you all with us, folks. Today, let me tell you, it's a very special day. It's sunny and bright. We're at the end of summer. The Pacific Ocean is looking startlingly bright and blue. And some miracles have happened. We've actually got electricity, and we've actually got the internet. We were off the internet for the whole of last week. Absolutely diabolical. Really, you don't think of Australia as a third world country, but technologically, I'm afraid it is. The perils of monopolies. We have a monopoly internet provider in our part of the Gold Coast, Queensland's playground. And when we get some rain and the pits fill up, out it goes. And how it should take them over a week to restore high-speed internet, just beyond me. But it's a beautiful place. Margot Robbie comes from the Gold Coast. She says she loves returning home to the Gold Coast because it has the best storms in the world, and she loves these big thunderstorms, which, being semi-tropical, we get our fair share of those. And it was one of those 10 days or so ago that set off a couple of bombers right over the top of us, and out went the power, and out went the no electricity, no internet, which meant no television for the kids. And boy, it was a grim week. Of course, I've got a little backup modem mobile, but it doesn't work well enough, really. Only very low speed, so pretty much a tortuous week last week. But this week's better, and God willing, so far, the electricity stayed on and the internet stayed on, and I'm always happy for small mercies. Chip saying I lost power earlier. We're good to go now. Just finished digging out the 18 plus inches of snow here in Maine. Mate, question, why do you live there? I mean, come on down to Australia. It's the Gold Coast. It's beautiful and sunny all the time. Okay, let's move on. I've got a lot to talk to you about today, and really happy to have so many of you with us. Thank you. Let's move on and have a look at what we've got to show you. We're talking today about markets and essentially what they are, what they do. Are markets forecasting machines or discounting machines? Which markets have qualities that forecast other markets' future actions? Trends, I'm always bashing your ears about trends. Trends continue until they end. Volatility is the oil which funds that nice rising equity curve. And it's also the tell of your trading system. In periods of extreme volatility, your system should maintain or even increase its level of accuracy. Most market tools lack this crucial feature. So I wanted to talk to you today about market engineering, and if it exists, it will show up with very, very accurate time and price levels, which will be calculated in advance. In other words, if you know how to use the tools we have that are themselves a form of market engineering, you will be able to calculate the future turning dates and the prices at which that's going to happen. In your analysis, remember, futures are generally more accurate than indices, but sometimes it's worth doing your analysis on both the futures charts and the indices charts. Let's move on here. Let's see if we can find something to come alive here. I don't know what that is. Is that it? There we are. See if this works. There we are. It's come alive now. This is a 12-day chart. The big interest, of course, at the moment is the equities, which are just having a massive dose of volatility, which is very, very welcome. This is the 12-day chart. You've seen it many times. I've shown it to you periodically over the years. And what's of interest is that you see the whole of this enormous bull market from March 2009 right up to now. It can be perfectly contained with a simple Daniel Code trading channel. And you see, as it went up, we've had that, we had a 2485 or 2500 is an important number earlier last year, and that stopped the market for a few weeks. These are 12-day bars. Each bar represents 12 days of trading. And the next number we had on the very long-term chart was 2883.27, and this market topped just a handful of points away from that. Have a look. This is the 6-day chart. It's showing you the same thing again. All of this price action from the March 2009 lows is contained perfectly within a Daniel Code trading channel, which runs only to 2 standard deviations from the mean. This tends to argue against random walk. This tends to argue that there is pattern and there is discipline in markets, and that there are limits to which way it will go and why. Let's have a look now at this. The next chart, this is the same chart you just saw, and I've enlisted the help of Sir Isaac Newton here to show you just how mechanical this whole bull market has been. Look at the first little arrow on the chart. It says 1 SD. That's 1 standard deviation from the mean. It's not your normal standard deviation. It's a Daniel Code standard deviation. It's slightly different. And Sir Isaac Newton, in his famous physics hypothesis, was that all markets have an equal and opposite reaction, which is something we see in most things in the mechanical world. And if any of you ever played pool or snooker, you're relying on Isaac Newton's third law. Every action has an equal and opposite reaction. So late 2009, early 2010, this market got up to 1 standard deviation from the mean. It then dropped to 1 standard deviation from the mean. There's its equal and opposite reaction. It then rallied up all the way, long rally into the second time it's got 1 SD on it. There it is hitting 1 standard deviation again. Then we got our only decent pullback that we've had in this whole bull market in early 2016. This market went down to 2 standard deviations from the mean, and that's why we've had the reaction to where this market's gone. It went down to 2 standard deviations from the mean. It's now gone up and rallied up and hit at 2 standard deviations above the mean. Now, I know it's easy to talk about those things in terms of the Trump rally and Goldilocks economy and everything else, but Newton's laws of physics predate any of those ideas, and you can see quite clearly on this chart that despite endless forests of trees knocked down to print paper and endless gigabytes of commentary and why is this so, the same rule applies. Markets react to the basic rules of physics. This is a little bit of a closer one on the S&P E-mini. This is the futures contract, incidentally. Futures tend to be a little bit more accurate than indices, which is an interesting thought. And what this has done, from it being 2 standard deviations below the mean back in December 15, we've now had this rally, which looks to me very much like a blow-off top and snapback reversal. Blow-off tops, when we do see them, we tend to see them mainly in commodities. They're not so common in really big, broad markets like these equity markets. But that looks, it's gone exactly. There isn't they're closed just minuscule above the 2 standard deviation line. And what this has shown is there's a classic, what looks at this stage like a blow-off top and reversal. Now remember, whatever we do with trading is based on probabilities. Trading's like life, it's all based on probabilities. You all assume that the sun will rise in the east tomorrow because the whole of your life experience has been that the sun rises in the east. And one day it won't. In the same way, you get in your car and you're driving along, you turn the wheel to the right, you expect the car will go to the right. Now, one day, hopefully you won't own the car by then, it won't, because if it's not properly maintained, the linkages in the steering system will get loose and sloppy and eventually break, and you'll turn your wheel to the right and the car will go straight ahead. So there's probabilities. They're very extreme probabilities, but they are still probabilities. So everything we do in trading, remember, all we're doing is talking about probabilities. This looks right now like a blow-off top and reversal. Subsequent price action may show it's simply been a correction down to the mean. That's the interesting part here. Look where this correction went to. The darker blue line in the middle of these lines here, that's the mean. And when we say markets revert to the mean, this is absolute classic demonstration of that fact. That's exactly where the sort of flash crash went to. Close enough. So here we are. These are going to be the key dark targets for the 6-day chart. I've put these numbers on for you. The mean is currently sitting at 25.26 and rising. Don't forget, this is increasing by a couple of points every week. 6-day chart is really the Daniel Code version of a weekly chart. The 1 standard deviation below the mean is at 23.72, and 2 standard deviations below the mean are down at 2225, and that's on the assumption that there's no change in the long-term trend and the long-term trend continues up. If there is a change in that, which hasn't happened yet, or we've had as a test of the mean, then these numbers are going to be very considerably low. But I think undoubtedly we're living in very dynamic times. I think it's going to be really exciting trading. Some of the best trading I can remember for some time. It's been fantastic. For those of you who listen to commentary on the various media with newspapers, web pages, websites, television stations, etc., you're hearing all the time that interest rates are driving this pullback in equities. Well, if you look at the 30, this is a very long-term chart of the 30-year T-bonds, and this is running since 1998. I've shown you this chart on many occasions. Have a look what happens in about here, this big arrow here, which is about August 2015, that's when the Fed said the first time it was going to raise interest rates. Now remember, this chart is the inverse of the yield. In other words, as this chart goes up, it means that yields are getting less, and as this chart goes down, it means that yields are getting higher. You can see where the top was made exactly. It was back in June 2016. We had a 59 time cycle there. We had price, we had the 2 standard deviations from the mean, and that stopped this market like it was shot all the way back in June 2016. Here we are, getting on to 2 years later. Okay, and ever since then, ever since mid-2016, this chart has been going down. In other words, interest rates have been rising. Okay, this is a future chart. It very much exaggerates the effect of price. But to argue now that as you will hear every day, if interest rates go up, that is what's driving the markets, equities markets down, is absolute rubbish. Look for the truth of these matters when you hear these statements. Don't accept them, because the reality is that people who are doing commentary, most of them are doing it for a purpose, to promote whatever their particular thing is, but it doesn't mean they know what they're talking about. And this idea that interest rates and equities are always in inverse correlation is rubbish. They are in inverse correlation sometimes. They're out of inverse correlation at other times. But you can see 2016, mid-2016 was the high in the UST bonds. And if the argument is true that interest rates are running the market, that should have been the high in US equity markets as well. And of course, it wasn't. This is an interesting thing I picked up from Zero Hedge last week. This is Goldman Sachs, the much revered and idolized bunch of good old fellas, I'm sure. I know a few of them. They're certainly good blokes. And this is the horrible Elliott wave virus. I don't wish to offend Rob Prechter, who's a nice bloke. I've met him on a couple of occasions. He's certainly a very decent guy. He certainly believes, very much believes wholly and totally in his version of Elliott wave theory, which is very little to do with the original Elliott wave other than the few basics. But more people have told me they've lost money with Elliott wave than any other program I can think of. So I know the big institutions are wedded to this stuff, and they shouldn't be, because it's crazy. But the whole point of here is that he's used to forget about all the little numbers on it. They're Elliott wave counts. Supposedly they may mean one thing, they may mean the opposite. The alternate of an Elliott wave count is always the opposite. But the thing that piqued my interest is the 200-day moving average, the 200 DMA he calls it, held particularly well at the lows. More traditional analysts use 50, 100, 200-day moving averages as if they actually mean something, and they don't. Their causation and correlation are not necessarily the same thing. I put the same thing on one of my charts, so you can see it here. The red lines, this is the equities, of course. This is the S&P, the broadest measure of the US equities. This is the market you want to analyze if you're trying to get insight into equities, because the others, the Dow is very narrow, only 30 components. Russell's just small caps, and the Nasdaq's just techs. So looking at the S&P, we put on these numbers, and lo and behold, what Goldman Sachs have told us is right. We never bet against the example. We would expect it to be right. And it is. We've got a nice conjunction of the 200-day moving average at the crash lows from the recent high. Let's look at another part of the chart. This is the same chart, just moved the dates a bit. Doesn't mean anything, does it? Absolutely nothing. And for any of these indicators to be useful, they have to be consistent. Picking out one thing to say, oh, the 200 DMAs worked well, it has this time, but look at every other time on the chart. It's totally meaningless. It's just a convention. It's a convention to use these 100, 200-day moving averages. Stocks guys use them a lot because people who trade stocks are inherently simple, in my view. And if they were smart, they'd be trading futures. And simplicity loves simple things. But this is a simple thing that when it works, it's very fine, but only works now and again, and not very often at that. So let's look at what's driving all of this sort of comment on markets, and I call it lunacy of the great unwashed. In 1973, a bloke called Burton Malkiel wrote a book called Random Walk Down Wall Street. Became very popular. It's regarded as gospel by many on Wall Street, particularly stocks guys. It's what's called the efficient market hypothesis, and it basically posits that there's no way of forecasting future market direction or quantum. And of course, this is a great way of defending the broker's adage of buy and hold, on stocks in particular. Buy and hold, buy and hold. And of course, that's really code for I don't know what this market's going to do. And the reality is, nobody knows what market's going to do. We don't have the gift of foresight. But to then say that all price action is random, which is what this hypothesis says. It's basically many years after the book was written, a young man wrote his PhD thesis, and he used the random walk hypothesis, inspired by Malkiel's book, to say that market prices evolve according to a random walk. So price changes are random, thus cannot be predicted. It's consistent with the efficient market hypothesis, which is a whole lot of rot. But this, believe it or not, this thing won the Nobel Prize in 2013, random walk theory. Got the official imprimatur, the seal of approval, and frankly, it's just not so. Let's show you why it's not so, because let's posit on an alternate market theory. Markets are not random, but are controlled by a sequence of ratios which create finite numbers in both the vertical axis price and the horizontal axis time. These numbers on both axes are known in advance. They're published in advance by me most of the time. The ratios on the horizontal axis are very limited. The ratios on the vertical axis are infinite. But within that infinity are the same core numbers found in the limited sample, but they repeat indefinitely, giving the appearance of infinity, whilst in reality being multiples of a limited base. If all that sounds like a mouthful, what it means is it's the same numbers, the same ratios, repeating again and again. Markets appear to have almost infinite ratios that create support and resistance. But the reality is, the good news is, if that was so, we could never find market turns. The good news is markets use the same 5 numbers again and again and again. All markets, as different as tiger prawns to T-bonds. All markets use the same 5 ratios again and again. And time and price are the same thing on different axes. I know that's very hard to get your head around, but they're simply support and resistance in time, which is the horizontal axis running along the bottom of your chart, and support and resistance in price, which is the vertical axis, the x-axis running up and down your chart. And these ratios control and limit all markets in all time frames, but are not themselves exclusionary. And this is Daniel's code. This is the code given to us in pretty well hidden form by Daniel. So what really makes markets turn? I mean, as we get into this period of nice volatility now, those of you who trade equities, which I know most of us do, it's really important that you can identify what actually makes markets turn. And if Daniel's code subsumes random walk theory, then markets will turn at known levels of price and known time cycles. And we should be able to know those levels of price and time in advance. And what we say is, when time and price are squared, a turn is almost inevitable. Now, that's not an original phrase. I got that from W.D. Gann, who was a stockbroker, a futures broker in Chicago, Jerry's hometown. and he was a leading light in his day. And he did one thing very, very well. And what he did is he taught stockbrokers that if you promote, you'll get more clients. And Gann was the world's greatest promoter, absolutely wonderful. Wrote a lot of books, made many presentations, left a massive amount of the system, Gann's trading systems, in all sorts of different packages you can buy for lots of money. Of course, none of it was true. But that's beside the point. He was a great marketer, and he got lots of people in. And there's a whole lot of people today who have great faith in Gann theory. And I did once. I spent 12 years of my life. I reckon I'm the most knowledgeable Gann trader in the world. I spent 12 years of my life and a serious amount of money doing Gann courses, buying Gann's various trading courses, buying original Gann charts, letters. I had people in London and San Francisco buying this stuff for me for ridiculous money. And it wasn't until I actually, eventually the knowledge came to me that it was all a great bit of marketing, but interesting. So when we say time and price squared, we don't mean what Gann meant, which is that time and price was sitting at one of his angles, at 1 by 1, 3 by 1, 4 by 1, the various angles that he uses. What we mean is that price will be at a known Daniel code number and time will be at a known Daniel code ratio, and they don't have to be the same. So if we talk about price being at the 50% level, we're not saying necessarily time has to be at the 50% level. That would be a 1 by 1 Gann line. It doesn't actually work like that. But I like the phrase so much, and as Mr. Gann's no longer with us, and I spent so many of my years and so much of my money researching all of his work, I figured he wouldn't mind too much if I used the nice expression he used in a slightly different way. So let's have a look at all this great volatility we've had lately. This is the S&P, which we're going to focus on today. This is the futures chart. You look at this chart, it does look horribly random, doesn't it? I mean, what made this market turn at the high? What made this market find that support at the crash low? What made the retest want to go to that line to prove how solid it was? What about all the other ups and downs? I mean, do they mean anything? Well, if you look at this, you're going to jump up and say, well, the Nobel people were right. It's random. All of this just happens. We don't know where it's going to happen and why it's going to happen. Let me try and prove to you that that's not true, folks. Have a look at this now in a little bit more detail. We can say that the January high came at a known and published DC price target. That was exactly, let me tell you exactly how many ticks away it was. That high that came on January the 29th, the high was 2878.50. We had a Daniel code blue line published weeks before at 2878. That's 50. That's 2 ticks difference between the price level we had as one of the Daniel code numbers and the price level the market attained. 2 ticks in a number like 2878. There's 10 ticks in each number, so there's actually what's available there is 28,000 ticks. 2 out of 28,000 as a percentage is minuscule, negligible. And we call that target recognition. And on this chart, I'm showing you a very simplified version of Daniel code time. These lines, vertical lines up and down the chart, are Daniel code time cycles. They're the dominant time cycles. 44 is the cycle for gold, which also appears in other markets. 59 tends to give us tops. Remember I said tends, these things can invert. 62 tends to give us bottoms. And 70 is the heathen time cycle, as I call it. In fact, there's nothing heathen about it. It just means it comes from a different part of the book of Daniel. And it's particularly effective on anything with a European flavor. For you Forex guys, the euro loves the 70 cycle, just loves it. and Sir Isaac Newton loved it as well. He actually wrote more about his Christian beliefs than he did about physics. And you can read some of his stuff. He's got a piece that's still available free on the internet. It's called Observations on the Prophecies of St. John. And he talks about the 70 cycle and what it means in terms of biblical prophecy. Those of you who are interested, go and have a look. It's very interesting. So anyway, our high, our January 29th high, came at a known Daniel code number, which had been published beforehand, and a known Daniel code time cycle. In other words, at that point, and indeed on the previous days, close enough, these time cycles were all valid for plus or minus one period only. We can say on this high and at the previous day, time and price are squared. And when time and price are squared, a turn is almost inevitable. Let's look at any validity in that. Let's go and have a look at the low. This low, which as Goldman Sachs said wasn't far from the 200 DMA, in fact that's just an approximation. That's like all of that ad hoc stuff and Fibonacci numbers. They're approximations. Put enough of them on a page, one or two of them will bounce. But have a look at this. The low for that move, 2528.25, was the Daniel code black line. A lot of you know what that means. It's the last level of support or resistance for any swing. And that particular low was 2529. In other words, it was three ticks away from the Daniel code black line, the last level of support or resistance for any swing. So at that low and heading into that low, we again had time and price squared. We had the market at or within 3 ticks of the Daniel code price, and we had an expiring 62 time cycle. In other words, we had time and price squared. It hit that number, reversed like a startled cat, and roared up. Huge. Let's see what else we can say here. Okay, then what happens is that this form of target recognition of time and price is valid at bar, high, low, or on the close. Both those forms of recognition are valid. So make sure you're testing for both of them. You can see here that from that low we had a retracement number at 2684.50, and the market, little rally up, it closed at 2684.50 on February the 6th. Exactly. Zero variance, right on the number. That's where it closed. Okay, so far, it doesn't look like this is too random. Really starting to look as if all of these turns, or some of them at least, have come at important Daniel code numbers. Let's move on. Here was the next thing that we saw in this little bit of chart here after we got the retest of the low, which came on another time cycle. Up it went into February the 16th. Look what happens at the close. The close of February the 16th was, look at the close, 2736.25. Look at the previous day's close, 2734.50. Look at the Daniel code red line there, 2736.25. The market on 216 was on a 70 time cycle, and it closed. This is the other form of recognition, bar, high, low, or the close. It closed close enough to that number. It closed 2736.25. Our number 2736.25. Try zero variance. How's that? Doesn't look random, does it? Follow this through and show you some more. We then had a little pullback down to February 21st. Didn't look terribly significant, but we had a retracement number there at 2698. Once again, this is happening on the close. It's switching. This market is switching between target recognition on the bar, high, low, and target recognition on the close. The close of that bar was 2698.50 against the Daniel code line at 2698. In other words, 2 ticks variance out of a possible 26,000 ticks. Why does the market do this? Why does it switch from target recognition at bar highs, buy lows, and then go to target recognition on the close. It does this because the markets have to. The way all markets work is they are most effective when 99% of the punters are wrong. So the market has this habit, it's a constant habit. It'll switch between bar high low for target recognition and on the close. It'll also switch between various sets of retracements. So going from any of these retracements, there are alternates to where you can put on the retracements, but you'll see them clearly what those numbers are. So on this particular day, 0221, it's a nothing sort of a day on the chart. It was an outside bar, closed right on the DC number. Next day, little push down, not far, turned around, key reversal bar up. And right, that closed right exactly on Daniel's number. Up we went. We're now up into 0227. This is particularly nice, isn't it? And you've got the two bars there. You've got one on February 26th and the outside bar that actually gave you the chart high. 0226 gave you the closing high. 0227 gave you the chart high. Always remember, folks, there's a difference between the chart high and the closing high. In this, you can see this bar that we're on right now, 0227, is the chart high. It has a high of 2789.75, but the bar before is the closing high. It has a close of 2784. And once again, here was the Daniel's number at 2788.25, and the bar of the 0227, the Tuesday, pushed itself up to 2789.75, which is 7 ticks difference. Marvelous, isn't it? That hit it like it was being stunned. It looked like a stunned mullet, reversed, ripped on down to the key reversal bar at the high. It also had a 59 time cycle expiring on that day. Now, these Daniel Code time cycles are valid for plus or minus 1 period. They're that accurate. They're only allowed 1 period variance. And that's because they can be started from either a chart high or low, or the closing high or low, so long as it's 1 standard deviation from the mean or more. You can see this market then turns around, it runs down, and we get this push down, and we have our next time cycle. The 62 time cycle normally gives us lows, can invert and go the other way, but that's typically what it will do. It will give you bottoms, and so it did here. And so we certainly had time there. What about price? Look at the close of the previous bar. The previous bar closed at 2679.75, and there was the Daniel's number at 2679. In addition to that, it was sitting happily at that number. We had another retracement on the members chart. It's still there. You can see it. It's at 2659.50. Very, very accurate. Time cycle turns it, off it goes, and this market's just been happily rallying away and using the DC numbers up and down as it starts to move away. Let's see what else we've got here. Here we are, 0301. This is one we missed. This was that little low I just talked to you about. And this chart's reminding me that I forgot to tell you that on the close, I think I did tell you it was actually squaring time and price on the close. Okay, this is where we are now. Now, all of this analysis is market engineering at work. What I'm saying to you is that these markets are turning at known Daniel time cycles. They're reacting, they're running up and down exactly according to the Daniel numbers. Immediately someone will say, yeah, but there are plenty of numbers. Which ones are they? That's something you can learn. And there are plenty of numbers. We can't put our finger on one in the future and say, that's the one that's going to turn it. But what we can say is that all turns come at known price levels and at known time cycles. And if you look closely at this chart, you'll see we have a time cycle tomorrow in this market, and the blue line, I guess, is going to be Monday. So watch closely. Once volatility starts, it takes quite a while to get rid of it, and we're just getting great trading in these equities here. The red lines you see on this chart, folks, I sent out an article about this. You should have seen them in the article if you're on our mailing list. If not, these are what we call fourth seal lines. These are lines drawn from particular market structures that forecast future highs and future lows. And you can see from the October 19th, 2017 bar, that's a low before the low. And taking that low and meeting the fourth seal rules, you can see that it forecast the high all the way into February 2018 pretty well perfectly. And that's extraordinary, because you then have to say to yourself, okay, the bars involved in this exercise are back in October 2017. They look fairly insignificant, just look like normal bars. Appears like the market's just randomly wandering about, but it's exactly those bars that create the fourth seal line which gave us that high, on target, on time. In the same way with the low, you can see that, I'll just jump this in a bit, we had a particular market pattern that qualifies as a fourth seal line. It's also arguably a fifth seal line, the one sloping down, and it intersects time and price exactly at the February low. These markets, these red lines are angles. This is the fourth and fifth seal, and an angle by definition have qualities of both time and of price. So you can see how perfectly all of this that looks like it's random, looks like it was a great panic, markets just absolutely reacted perfectly. It's gone exactly to the next DC number. It's gone through a lot of them without reacting. Don't let me give the impression that there's only one number. There's a horde of numbers, and it's ignored a lot of them until it found the black line of what is obviously a fairly important swing. And since then, we've been able to find every low, every high, and this happens all the time. This is market engineering. This is real market engineering. Here's copper. I've just thrown this chart in to show you, apropos of nothing, exactly the same thing. This is not something that's exclusive to the S&P, but it's more easy to see. This form of engineering is much easier to see when there's good volatility. And you can see with copper, this is the 057 continuous contract, big run up. I'll see if I can find it here and give you the exact date so you can follow it in your own charts. So big run up into December 28th, 2017. That was at a Daniel code blue line, Daniel's number 33080. The close of that bar was 33085. So this market actually moves in 5 tenths of a tick, so that's 1 tick variance on the close. And we had a DC time cycle expiring the following day. So as I told you, these markets, the time cycles are valid for plus or minus 1 period only. So the fact that our 70 cycle expired the following day shows us that we could have well have been expecting that to trigger a day early, which in fact it did. We move on, we come to the important low here, the intermediate low, which you can see on February the 9th. That's this turkey right here. Have a low on that bar, 302.60. There was Daniel's number on the chart at 302.80. From there it rallied, and the high, the little spike high, 4 or 5 bars later, came in at 327.20. But more importantly, look at the close of the setup bar. That's the bar before it, February the 15th. That bar closed at 324.55 against the DC red line at 324.55. In other words, This market is doing exactly what we showed you in the S&P. It's swapping between target recognition at bar high, bar low, to taking up target recognition on the close. And that's a characteristic of all markets. That's another form of engineering. It's the same product, but it's just changing its shape to confuse everyone. The rules of market are that they won't move until they've got 99% of the players wrong. And that's another little trick that all markets play, the switch from target recognition at bar high low to market recognition on the close. So always have a close only chart as well as your normal bars. You'll find that it really will pay dividends for you. I haven't continued with this, but I can tell you that high came right on a Daniel Code time cycle. Here it is. It was a 62 cycle. Expired on, here's the date, 0216. That's the high. 2 to the right of what's shown on this chart was another 62 cycle. Okay, same thing. Time and price is what makes markets turn. This doesn't look very random walk to me. If this was random walk, we wouldn't be able to put these numbers on and watch the markets moving into them and then reversing. And we've been doing that for over 10 years. There's 35,000 approximately charts at the Daniel Code website. You're welcome to go and click on that link, chart archives, and go through every one of them. It's almost impossible to find a chart that's turned anywhere except at one of these DC price levels. What you don't see there is the time levels. Trading time is really the new frontier. We're getting extraordinary results from people who are doing tutorials and learning to trade time. Hello, Ed, just joined us. You're one of them. He's doing it right now over there on the West Coast. Ed, good to have you with us. The website is primarily designed to show you price. If you're interested in trading time and seeing this sort of analysis, you need to do a Daniel Code tutorial with me. Okay, let's move on. Plenty more interesting things here to think about. Here we are. What is there to think about? Yeah, here we are. If you want to be a super trader, want to be an elite trader and trade this way, time and price, and best of all, simply trade standalone time signals, do send me your phone number and country and location so I can work out roughly when I can expect you to be awake, and I'll give you a call on the phone. We can discuss your trading and what it is you'd like to do and how I can take you from wherever you are now up to the elite level. It's been very successful. We have a big number of people with us today that have done tutorials, and they're all very happy folks. They're now making money at levels that they didn't dream was possible. It's all very exciting. Okay, if you haven't already, folks, you're most welcome to have a free trial of everything at the Daniel Code. Just go to the website, www.thedanielcode.com. Click on the link, and any problems that you should have, that you should be able to register a username and password, and the wonders of technology will set you up with a free trial of everything that we have for 31 days. If you have any problems at all, please email Terry, who's at support@thedanielcode.com. That's in Canada. It's our main Canadian office, and he'll be happy to help you. Similarly, if you haven't yet had the use of Trade Navigator, they're our partners, and we'll be happy to arrange, Terry will be happy to arrange a 31-day free trial of Trade Navigator for you. So there's no reason not to be involved in trading. We can set you up with a free trial of everything. And for those of you who really want to become elite traders, you can do a tutorial. I'll teach you everything I know, which is quite a lot more than most. Okay, what else have we got here? I'm required to show you, I always like to show you my compliance statement, which is sort of blurred a bit, for which I apologize. This is converting from an earlier session of Windows Office to the new upgraded, all new, all singing, all dancing version, as Microsoft like to do, keep driving you mad by upgrading the product constantly. And it looks to me like this paid isn't terribly happy. But the compliance message is, for goodness sakes, do be careful. Please don't risk trading money in futures or spot forex until you actually know what you're doing. Almost everyone loses all their first bank, and many lose their second and third bank as well. Once you know how to trade, those risks can be managed and controlled, and you will continually be on the right side of the market. But it's a funny thing, trading. It's the one thing that people seem to think they can become really, really proficient at without any training. And also the other belief is that you can learn anything you need to learn from books and the internet. And I had that belief 25 years ago, and it's not true. The number of people who really do know how to trade and can teach you trading are very, very few. So let me know if you feel like you're more interested in some more detailed knowledge of trading futures or spot forex markets, and I'll be absolutely delighted to give you a call and talk with you. Okay, that's the end of our slideshow. I forgot to thank Terry for doing our banner. Here's our banner. Let me see. I'll just blow this up again so that you can see it all. Here it is. And Terry's marvelous. I do these webinars periodically, and whatever I'm doing, Terry comes up with an absolute marvelous banner. So I do want to thank him very much. He does a great job for us. Okay, let's see what else we've got here. We've got some questions. Let's see what's happening with the market. This is copper, what we were just talking about. Okay, let's got some questions here, folks. First is Akshay. Hi, John. From the perspective of significance to target recognition at a DC retracement level, is a close or high low more or less important to determine a change? No difference between them. Akshay, target recognition at the close or at a bar high or low is valid. Naturally, if the market's going down, we want to see target recognition at the low or at the close. If the market's going up, we want to see target recognition at the high or the close. Tom wants to know what's happening with the Dow. I'll get on that in a moment. And a quick update on DX US dollar index. And Ed says, excellent seminar, thank you. Yeah, we can do all that. We had a signal elected today on the DX. Actually, I hope you didn't miss it. We had a buy signal for Wednesday on DX, valid for Wednesday and Thursday. Let's see what happens here. Here it is. I think we're still in the, we're still getting towards the end of the March contract. You're going to have rollover, folks, on Wednesday. So we had a buy in this market. Let's have a look what we've got on our bigger charts. We've been following DX pretty well on the bigger chart. Here it is. Actually, let's see where we are. Let's get to the end of it. Wow. Okay, you've seen this chart many, many times. We had we had 88.34 has been a target since early beginning of 2017, and that's where it's got to. Look at this. It's hit that target and just rallied. This market's in a strong downturn. It's going to take a fair bit of work to turn it around. This is a 6-day. This is a 6-day chart. Market big currencies like this, or in fact all currencies, don't actually move on their own. They move because they're made to move. They're driven by government policy or by the failure of government policy. In which case we have a very, very clear line on this market. Steve Mnuchin, the new Treasurer of the United States of America, said that he favors a weak currency and he wants the currency weaker. Donald Trump's been saying that for years and years, and no doubt this push down, although it's not entirely driven by those comments, it's certainly being helped that way now. Why is a cheap currency beneficial for people in government to want that? Well, it makes your imports, if your currency is weaker, it makes your imports more expensive and your exports more affordable. In other words, it makes your exports appear cheaper to your trading partners. Most rational-minded people involved in the management of a trading entity like the United States will always want their currency to be weaker. The other thing that drives currencies, very much in the short term actually, is interest rates and the difference between interest rates. In other words, it's the opportunity. I actually want to show you a daily chart here. This is our 6-day chart. Let's see if we can get you a daily chart. We don't want that one. We don't want this one. Do it. DX, here we are. The theory behind currency is relative currency. It's not a total absolute currency moves that bias, but have a look at this. This is the Australian dollar. It's trading now around, here we are, it's down about 77 cents or so. Hugely overvalued, quite ridiculous. This market was at $1.08 US for many, many months back in the mining boom. Completely crazy. This market really, in true value, should have a 6 in front of it. But just have a look at this, just something to amuse you. This is the Tuesday was the Australian Fed meeting. We call it the Reserve Bank. And they decided that interest rates, the usual 21 out of 23 economists predicted that interest rates would be raised. The Reserve Bank, Australian Reserve Bank, said, no, we're not raising reserve banks. But have a look, this market went up. It got stronger as if the interest rate had been increased, and it wasn't. This really just shows a market that's reacting to perception rather than reality, and it's given up almost all of those gains since then. Tom wants to know what's happening with the Dow. Let's have a look. This is the mini Dow, Tom. Here it is. Well, we had a nice plus signal up here, mate. I hope you got that. We had a plus signal for the sell on January the 29th. I haven't updated the rest of the chart. This is just consolidating within the range. Here's your big operating range down here. This is a nothing sort of a consolidation. In fact, this market is weaker than the other markets. Now, tops, if this is a top, it takes an age to happen. It doesn't just go down and whoops, it's all over. It takes weeks and weeks and weeks for tops to come in. I suspect that this is probably an interim top. My guess is that this market has fallen to the median of its long-term Daniel Code trading channel. That means the trend is still up until it breaks that on a closing basis. So the trend is still up, and what we'll be watching for is a change. This market's too small, too narrow to give you real analytical potential, but keep your eye on the 6-day chart in the S&P, because that's the market. If you want to know what's going to happen with any of the equities, it's going to come out of the analysis on the S&P. Here we are. Have a look at this. This is the standard deviation. You can see it just bust through the top. That's the two standard deviations from the mean, and it came down and tested the mean. Let's see what else we've got in here. We might have an yes. Had a time cycle, folks. Look at this one. The 59 time cycle expired on Thursday, February the 1st. Remember, each of these bars is in fact a 6-day bar. So that high came right on time for a 59 time cycle. Here we are. This was a better one to see. So this is the one we showed you a bit earlier. There are various ways of drawing the DC trading channel, Tom, and the simple way is you can bang it up to the end if you've still got the two requirements, contact with the first push out, which is here. And this shows you that you've had a break above 2 standard deviations. I've talked to you about that. And here's a support. It rammed down. Now remember, this is not a static line. This is a line that's increasing every week. And right now it's at about 2784. 2784. No, that's the close. This market down is at 2530. So watch for this at the moment. This market and the Dow are holding support at the 1 standard deviation. That's very, very strong. And I suspect it's not able to support that. I suspect it'll drop back to the mean. And as long as it's getting support from the mean on this chart or the Dow equivalent, the market is still okay. It's been ridiculously strong, as you know, and it's just done exactly what we've seen markets do so often. Get to 2 standard deviations from the mean. On the daily chart, it's at 3.5 standard deviations from the mean, and whenever we see that, we say this can't last. And that was exactly the case with these markets. All right, so there we are, folks. Shoot me an email if you'd like to look at these things. Rose, NQ, Nasdaq, exactly the same, Rose. It's a little weaker. It's a little weaker. Let's see what happens in here. Let's see. Nasdaq. Now, don't trade markets just because you like them. I was talking about that earlier in reference to TomTom's partner, who's very much wedded to natural gas. When that market stopped trending, you know, that's time for you to be elsewhere in other markets, okay? This is the Nasdaq. Can't actually see all of it. Got most of it here. That's actually not valid. Let's take it back until it is. There you are. That's valid. So have a look at what's happened here. This is extraordinary, isn't it? I think I told you that this went up 3 standard deviations from the mean. There it was. That's where it was attacking at 3 standard deviations from the mean. This was back a bit further then. There we are. Right on 3 standard deviations from the mean. Anytime we see that, we say this can't last. Well, have a look what this market's doing. It's trying to go higher again, and it may well do. But at any stage that it's near or above 3 standard deviations from the mean, it's certainly vulnerable. Hope that helps you, Rose. Drop me an email if you'd like any more information, sweetie, but always nice to see you here. And that's us for today, folks. Thank you for being with us. I trust you've enjoyed it all. Hank's with us. Hello, Hank. Good to see you. Hope you're getting plenty of rain down there. We've been getting buckets up here, mate. Good to have you with us, and we'll look forward to seeing you next time. Bye-bye for now.